Welcome to the Deep Dive. We're here to break down complex reports into insights that, well, make sense for you.
Glad to be here.
Today, we're tackling the latest numbers from Monster Beverage Corporation, their second quarter of 2025.
Yeah, a really interesting set of results came out.
Our goal,
Yeah.
to unpack those numbers, figure out what's really driving things, and maybe find some surprising strategies behind their continued growth. It's a tough market out there.
It really is. And Monster is definitely a key player to watch. I mean, right off the bat, their performance this quarter was, well, pretty remarkable.
Remarkable is a good word. They hit a huge milestone, didn't they?
Yeah.
Record quarterly net sales.
They broke the $2 billion mark for the first time.
Wow, $2 billion. That's a serious number for one quarter.
Absolutely. If you look at Q2 2025 versus Q2 last year, net sales jumped 11.1%, so $2.11 billion, up from $1.90 billion.
Yeah.
And even if you adjust for foreign currency stuff, it was still up 11.4%, so solid growth across the board.
And it wasn't just sales. The profitability looked really strong, too. Operating income, what was that?
Yeah, operating income climbed almost 20%, 19.8% to be exact, hitting $631.6 million.
Okay. And I saw there was an adjusted figure, too, non-GAAP.
Right. So non-GAAP adjusted, which kind of smooths out some one-off items, that was up to even more. 21.5%, reaching $667.9 million. Strong core performance.
Which flows right down to the bottom line, I assume. Earnings per share?
Exactly. Net income per diluted share soared 21.1% to 50 cents. And again, on that adjusted basis, up 23% to 52 cents per share. Really healthy increases.
And this wasn't just a fluke quarter, right? Looking at the first half of the year.
No, exactly. The first 6 months show a similar trend. Net sales up 4.4% overall for the half, nearly $4 billion.
Okay.
And net income up 7.4% to $931.8 million. So it's sustained momentum.
The CEO, Hilton Schlossberg, commented on this, didn't he? Something about brand strength.
He did. He pointed to, and I'm paraphrasing a bit, the strength of their brands, the talent of the team, and, the fact that people around the world keep buying their products.
Makes sense.
And he specifically called out product innovation. Said the success of new launches and their robust pipeline are really key for long-term growth.
So what does this mean for you listening in? Well, it's a chance to see how a big player in the beverage game keeps winning, how they navigate growth, keep innovating.
And leverage their strengths, yeah. Even when the economy's doing, well, whatever it's doing globally, it's a great look at combining brand power with smart operations.
Okay, so we've seen the headline numbers shattering sales records. But like you said, it's also about turning sales into profit.
Precisely. And that's where the gross profit margin comes in. It jumped to 55.7% of net sales this quarter.
Up from, what, about 53.6% last year?
Exactly. That's a nice improvement. More profit for every dollar of sales.
So how'd they pull that off? What were the main reasons?
Well, the report cites a few things. Pricing actions, they took smart pricing, optimizing their supply chain, which is always ongoing.
Right.
And they actually benefited from lower costs for some inputs like ingredients and packaging. A bit of a tailwind there.
But it wasn't all gains, was it? There were some offsets.
Yeah, a couple things. Changes in where they sold products geographically, the sales mix, and slightly higher promotional allowances kind of ate into those gains a little bit. It's always a balancing act.
Always. And that balance comes through in operating expenses too, right? They went up, but maybe not as fast as sales.
That's right. Total operating expenses increased about 10.7%. To $544.8 million. But, and this is key, as a percentage of sales, they stay pretty flat, 25.8% this year versus 25.9% last year.
So they're scaling efficiently, costs aren't running away from them.
Seems like it. And if you dig into the details, distribution costs actually got more efficient, dropped from 4.6% to 3.9% of sales.
Oh, interesting.
Selling expenses also down a bit, from 10.1% to 9.3%. But general and administrative, or G&A, did tick up. Went from 11.2% to 12.6% of sales. That's about $266 million in dollar terms.
And they called out specific reasons for that G&A jump, didn't they? Something about stock awards and legal stuff.
Yes, exactly. Almost $8 million linked to new equity awards with a, quote, retirement clause, which sounds like a way to keep key people around.
Interesting retention tactic.
And another $13.8 million set aside for litigation provisions. Legal costs are just a reality for big companies.
So true. It really raises that question, doesn't it? How do you balance pushing for growth, controlling costs day to day, but also making those necessary strategic investments? in people, in legal protection.
Absolutely. Even when things look great on the surface, there are always these underlying costs to manage for the future, for stability, for keeping your best talent.
Okay, so we've hit the top line. We've looked at profitability and costs. Now let's get into the products. Who's winning in the Monster portfolio, and are there any struggles?
Well, no surprise, the Monster Energy drink segment is the absolute giant here.
So the core, yeah.
Oh, yeah, it's like 91.7% of their total net sales. And sales there grew 11.2% to almost $1.94 billion. That includes the main Monster drinks, Reign, Rainstorm, Bang Energy.
Yeah.
It's the engine.
Clearly. Just dominant. But what about the other segments? Strategic brands, that's where some of those acquisitions went, right?
Correct. And that segment actually showed really strong growth. Sales up almost 18.9% to nearly $130 million.
Right.
That includes brands they got from Coke, plus their affordable energy lines like Predator and Fury. They saw more volume for Burn, NOS, and Fury. One note there, concentrate sales can make this segment's numbers jump around a bit more than finished drinks.
Got it. Now, the alcohol brand segment, I saw that was different. Sales actually went down.
Yes, that one is really interesting. Sales decreased 8.6% down to $38 million. This is their craft beers, malt beverages, hard seltzers.
So why the drop there? People just not buying the Beast Unleashed stuff?
Yeah. Well, the report points to lower volumes for some craft beers and specifically mention Nasty Beastie Hard Tea in the Beast lines. So yeah, maybe some products aren't hitting as hard. But and this is the twist, the operating loss in that segment actually shrank significantly, down over 35% to $14.6 million.
Wait, so sales down, but they're losing less money. How does that work?
It suggests they might be getting more efficient, maybe cutting costs, or perhaps discontinuing the least profitable parts of that alcohol lineup, like strategic pruning, trimming the fat, so to speak.
Okay, that makes sense. Focusing on profitability, even if top-line sales dip in that specific area.
Seems like it. And then there's the tiny other segment down about 8.5% to $6.4 million. So definitely a mixed picture across the whole portfolio.
Reinforces that not every bet pays off immediately. But they're still innovating, right? Launching new things.
Absolutely. They mentioned new Zero Sugar Monster flavors collaborations with Lando Norris and Valentino Rossi, plus a whole line of lemonades, Blind Lemon and Blinder Lemon, in different flavors like cherry, peach, strawberry.
Always something new on the shelf.
It really stands out, doesn't it? The core energy drinks are just this massive, reliable growth engine they keep feeding with new variations.
Yeah.
While in newer areas like alcohol, the strategy seems more about, well, refining things, maybe finding profitability, possibly pulling back where needed, while just continuously innovating in that core energy space.
It's clear that core is strong, but their global reach is a huge part of the story, too. International sales are booming.
They really are. Sales outside the U.S. jumped almost 16%, 15.8%, hitting $864 million in the quarter.
Wow.
And importantly, that international piece is becoming a bigger slice of the pie. It's now about 41% of total sales, up from 39% last year.
So their global strategy is definitely working, diversifying them beyond the U.S.
Absolutely. And you can't talk about global reach without talking about their key partners, their customers.
Right, those big bottlers and distributors.
Exactly. Based on gross billings, Coca-Cola Euro-Pacific Partners is about 15% of their sales. Coca-Cola Consolidated is around 11%. Reyes Holdings, another big one, about 9%.
Those are massive networks. You need partners like that to get products everywhere.
You really do. And that ties directly into the relationship with the Coca-Cola Company, TCCC.
Yeah, Coke owns a big stake, right?
About 20.9% voting interest. And that relationship shapes a lot. Commissions, Monster pays for distribution through the Coke system, buying concentrate from TCCC, using Coke bottlers for manufacturing. It's deeply integrated.
So just how vital are these international markets and these big alliances for Monster's growth? It feels like they're pretty fundamental.
Oh, completely fundamental. They provide the scale, the distribution muscle, the market access. It's hard to imagine this kind of global growth without them. They're the backbone.
Okay, so the operations look strong. The partnerships are key. Let's shift to the balance sheet, the financial health side of things. Growth is one thing. Financial stability is another.
Good point. And they look pretty solid there, too. As of the end of June, they were sitting on $1.93 billion in cash and cash equivalents.
That's a nice cushion. A lot of that held overseas.
Yeah, about $1.1 billion of it held by foreign subsidiaries, which is pretty common for global companies.
And they made a move on debt recently.
They did. Paid back $200 million in long-term debt back in April.
Okay.
Plus, they have a $750 million revolving credit line available through 2029 that they haven't even touched. No outstanding borrowings as of June 30th.
So very strong liquidity, not relying on debt. That's a position of strength.
Definitely. It gives them a ton of flexibility.
And interestingly, while they have authorization to buy back shares, about $500 million worth still available.
Right.
They didn't actually repurchase any shares in Q2. They held onto the cash instead.
Which could mean anything, really. Maybe they see better uses for cash coming up investments, acquisitions, or maybe they just want maximum flexibility right now. Hard to say for sure.
And operationally, they're generating good cash flow.
Very strong. Cash from operations was almost $1 billion, $973.6 million for the first 6 months of 2025.
Wow.
And that was helped by reducing inventory levels and an increase in accrued promotional allowances, basically. Good working capital management. They're turning those sales into cash efficiently.
So thinking about all this, the strong cash position, very little debt, paying some down,
Yeah.
what does that tell you about the company's confidence, their view of the future?
Well, it generally signals strong confidence, right? It suggests they feel they can fund growth, handle economic bumps, maybe even pounce on opportunities without needing to borrow heavily. It paints a picture of management feeling pretty secure about their strategy and stability.
Okay, so let's wrap this up. We've dug into Monster Beverage's Q2. We saw record sales, breaking that $2 billion barrier.
Yep, improved profitability too, driven by pricing, cost control, even some lower input costs.
A product portfolio that's still overwhelmingly dominated by energy drinks, but they're clearly experimenting and refining in other areas like alcohol.
And that global footprint just keeps expanding, powered by those really crucial distribution partnerships, especially with the Coke system. Strong financial footing underneath it all.
So here's a final thought for you to consider. Monster has incredible strength in that core energy market and this huge distribution network. As they try to push into other beverage types and as consumer tastes keep shifting towards health, functionality, new experiences,
Yeah.
what does Monster's power, their brand, their reach mean for the rest of the beverage industry? How might they shake things up even more beyond just energy drinks in the future? Something to think about.